So welcome you all once again to today's section. Today we will look at the common size analysis. So common size. So common, as the name suggests, to common size analysis. Common size analysis. Now, it's a type of analysis where we express all the item as a percentage of a common base, all the items in the financial statement. What are the financial statements? Number one, we have the profit or loss, the P&L. Number two, we have the changes in equity. Number three, we have the financial position. Number four, we have the cash flow. Good. Now, with a common size, you just have to focus on the P&L and the financial position. Cash flow and changes in equity, no. But I am doing that to complete the game. Of course, I have to complete the game. Now, common size simple means express all the items in each of the financial statements as a percentage of common base. Right. Now, with the common size analysis, you have to relax. Step one, locate the common base. Step two, express all the items in the financial statement as a percentage of the common base. Each and every financial statement here have a different common base. Take note, we don't have a common base for all these financial statements. No, not at all. So for profit and loss, the common base is sales revenue. Sales revenue. So it means that you have to take all the items in the financial statement, in the profit and loss, divide it by the sales and multiply it by 100. So each of the item, so here to be each of the item, so the item that you are requesting over the sales revenue times 100, that is the common base. You do everything, all of them, from first to the last, and then you are done. Okay, great. So that is the common size analysis. Please, the common size, we have the calculation of the ratio itself and the analysis. So there are two things. After expressing all the item as percentage, you don't need to end there. You go ahead and use it to write a report. So common size goes beyond just the calculation. Or if it's the calculation alone, because the formula is only one, then you are done. For changes in equity, all the items normally goes to the financial position. So it will be together with the financial position. So it's the total asset. Now let me look at the critical ones first. Financial position, the common size is total asset. Total what? Asset. So all the items in the changes in equity to also follow the same portion because they go to financial position, total asset. Now for cash flow, you use what you call total cash inflow. Total cash inflow. Total cash inflow or outflow, any of them. Cash inflow. Well done. Total cash inflow. So that is for cash flow. That's all we are done. So now let's pick few point or analysis to look at this. We're going to pick a question, right, to look at it. The calculation is a bit simple and the one formula for all of them. We don't have So as a result of that, I don't need to show the workings or show the formulas for us. No, because the formula is only one. So, and okay, so we are going to look at this particular question. So as usual, I'll go straight to the requirement. Write a report to the board of Akwesi Papa Limited analyzing the financial position of the company using any two key ratios. So look at this carefully. We're going to analyze the financial position. When you talk about financial position, the ratio that you have to use current ratio, that's the liquidity and gearing. That's all. It's liquidity and gearing. So here you don't touch anything from the P&L. Everything must be the financial position, liquidity and gearing. Then you can also use what you call the profit before interest and tax. Great. Okay, so there's a question here for us. Let's go and pick the question up. Okay, great. Now, it said financial position. Financial position, you don't need profitability ratios. You don't need, how do you call it? The other ratios. You don't need the market positions. Financial position, you need one, liquidity ratio, two, that of the solvency, three, efficiency. You are done. Aside these three, you can't use any other ratio again to analyze the financial position. So the best two are the liquidity and gearing or solvency. That's all. So, and you can do that. Okay. Then B, using common size into bracket vertical analysis. Write a memo to evaluate the performance of the company. So here is a profit and loss, and then the financial position. I am interested in the common size, so we'll go through the common size. So go to the common size. Good. So all what you have to do is, first of all, you start with your calculation. So that means you go to the financial statement, all the items. So let's start with the financial statement. Question one. It says Akwesi Papa Limited is a private company in Ghana with a CEO of what? Akwesi Papa, and a majority shareholder, and recently joined the board to analyze the performance of the company. Extracts from its most recent financial statements are provided below. So 31st March 2017 and 2018. Great. Now, if you are doing common size financial statement, you pick all the items and express them as a percentage of the common base. So all the items that you see, please, the profit or loss is start from sales revenue up to profit for the year or the profit after tax. So you have to start from sales and end at profit after tax. Do not worry yourself and move into the dividend section. Great. So you start from the sales revenue. So what's the common base here? Common item, sales revenue. So you pick cost of sales, then you divide it by the sales, then you multiply by 100%, then you put the answer down. So this is how the format will be like. So first, we have to write the common size analysis. So common size. I write here the profit or loss. I'm calculating the profit or loss. What I'll do is I'll put 2017 here, 2018 here, and start my sales revenue. As they have arranged it, don't need to change it. As they have arranged it. So sales revenue, cost of sales, admin expenses, It seems that there's a figure here which is missing though. Okay, the top one is the distribution cost. Distribution cost, I think, decided to vanish. So distribution cost supposed to be here in the middle. This particular figure is distribution cost. Okay. So cost of sales, cost of sales, gross profit in that order. So sales, cost of sales, gross profit, distribution, admin. The next one, what did they go to? As they have done it, too, don't change the format too. From there, they go to operating profit, profit from sale of division. So in that order. So operating profit, then profit from sale of division. Then you take your calculator, but down out to antipart profit after tax. Good. So you got everything there. What's the common size in a profit and loss statement? Common size the sales revenue. So pick each of the item, divide it by the sales revenue times 100. You are done. So I'll do the calculation for you. So here will be 60,000 divided by 100,000. Please, to avoid confusion, I'm begging you, don't do the 2 years at the same time. You may swap their common base. So finish 2017 first. Then when you are done, you do for 2018. That is all. Good. That is what all. So here will be 60% because 60,000 divided by 100, 60%, 40%, 10.6, 1.6, 27.8% in that order. Then go to 2018. So here we have 60%. If you like, you can put a percentage here like this to cover all. Sales revenue, we had 60%. Cost of sales, in fact, sales is always 100%. Start from the one that very first one. So we start from sales revenue. Sales revenue is 100,000 divided by the common base of 100,000 times 100, which will give us 100. So it tells you that the one which gave us the 100 is the common base. Then you just have to change the top. The next item on the list is cost of sales, which is 60,000. So divide the 60,000 by the common base, 100,000 times 100. The answer will be 60%. So cost of sales is 60. You go to the gross profit, which happened to be 40,000. So that will give us what? 40%. So here is what? 40% in that order. And it will continue to the end. Now let's go to 2018. Let me do one or two there. Then we move on. Then I'll project the calculated one. So 2018 sales is 72,000. So sales, the percentage will be 100%. So that one there, don't even worry yourself to calculate. Put 100 here. Then go to the cost of sales. With the cost of sales, bring 72,000. Cost of sales 48 divided by what? 72,000 times 100. So that would be 2018. And you don't need to show these workings, no. 72,000 divided by it was 48,000 divided by 72,000 times 100, and that will give us good. So that will give us 66.67. Then gross profit. Let's go and pick the gross profit too. The same thing. Let the gross profit to be 33,333. Plenty three. Gross profit is 24,000 over 72, which is 1 divided by 3. And that'll give us 333,333. The 3333. Let's show the working. It's 24,000 divided by 72. times 100. This will give us 33.33333%. Then you put it in. And it's continuing in that order. That is the common size calculation. When you are done, then you write your reports. That's all. If you take the financial position, common size financial position 2, let's look at that one too. When you are done, don't worry, I will give you the full solution. For the material, it contains the full solution. So it has been calculated and dealt with. So let's confirm the figures. So let's see. Okay. So if you check, this is the common size. So calculation of the percentages. Everything was there. Have you seen here to the name didn't pop up? The distribution cost. So this will be the percentages, and then you are done. You just have to show them like that. So up to profits after tax and for the year, I'm done. That is all. Those that do not have an item, you just make it dash. So that is it. Great. Now let's go to the common size financial statement. That one, what is the common base? The common base is total assets. Common base is what? Total assets. Let's do the calculation. When you are done, then we start with the report. How to write the report. So we start financial position. Financial position. Now on to as they have arranged the question. So let's go to the question again. As they have what? Arranged the question. As they arrange the question, we should use the same thing. As they have arranged the question, we should go by the same thing. As they have arranged the question. Okay, so financial position. Then there's a question here for us. Let's see if we can pick that one up. Please, you have to do for all the items that you see, all the items in a profit and loss from sales revenue up to profit after tax. Yes, you're supposed to do for profit and loss. Good. Profit and loss have a different base from that of financial position. So now we are done with the profit and loss. We are come to do for financial position. How to get a percentage for the financial position. How we get it? Good. Okay. Now the financial position, the common base is total assets. So this statement of financial position for Akwesi Papa Limited. Now, the common base here is the total asset. Did they name it? Look, oh. So this is the total asset. Oh. Yes. So you pick all the items and then you divide it by this total asset and multiply by 100. That is all. So all the items, PPE, oh, only PPE. Then you go to inventory, go to receivable, cash at bank. Then you go to ordinary share capital, retained earnings, all the items one after the other. All the items one after the other. Then you are done. How we get it? Good. So that one, so let's try and see if we can do maybe one or two. So let's try. In fact, the common base has already been identified. That is all. If it is profit and loss, choose the sales revenue. That's the common base, P&L. If it is financial position, common base is total assets. So at the inception, the common base that we listed, profit and loss, the common base is sales. Financial position, your common base is total assets. If it is cash flow, common base is total cash inflow. And then you are done. but these are the two popular ones. It is something that it's a formula that we have identified already. So you don't need to identify or select any other base apart from what we have. So profit and loss must be sales revenue. That is the common base. So if you go and then they say do common size analysis and it's a profit and loss. Oh, sales revenue, locate it. Okay. Express all the items one after the other as a percentage of the. So let's look at two. The first item on the list is PPE. No shortcut. All right, PPE here. I'll take my calculator or the PPE value. I'll do year by year to avoid confusion. I'll do year by year. I'll not put all of them together to avoid confusion. I'll do year by year. So what I'll do is this. So PPE is 42,000 here. Total asset is here. This total asset 58,400. 58,000. So 42,000 working somewhere. You don't need to show the workings. Here, no formula, no workings. Do everything on the calculator and throw the answer in. But the items are many. If you say you're going to show workings, you won't finish right now. Over 58,400 times 100. We are done. So what will be the answer? 72%, right? Perfect. So here will be 72. Put a percentage here. Now let's go to inventory. The next item is inventory. You don't need to tell us that this is non-current asset. Current asset. No, 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 no. It's not part of the game. It is not part of the game. If that item there's no figure attached, don't even worry yourself. So we are picking those that have figures. Current asset, I'll not touch it. I'll go to inventory. 11,600 over 58. So I just have to change the top up to 11,600. And I'll give us okay. So great. So that'll give us 19.86. 19.86. Great. Great. 71.92. Good. Okay, so we move on to the next item. Oh, I've cleaned the bezel. 58,400. It must be the same, constant. Just be changing the top. The next item, like that. So now that you've gotten the concept or the idea, let's see. 4,800, right? Divided by the 58,400. So that means 4,800 will be here like this. And that'll give us 8.22. Good, I like that. So I write a receivable. 8.22. I'll go to cash. Here, dash, there's no cash balance, but 2018 had some. Now go to total assets. Total assets. Total assets. If I sum all this, I must get 100. Or I'll take 58,400 divided by 58,400 times 100. That is it. So this is the common size calculation. So that is it. Now that you know how or we've seen the structure or the game, we can still go and then audit the solution. Can still go and then audit the solution. Okay. So where is it? Can't find it though. Okay, so this is the question. Is a common size analysis. So for financial position, yeah. So 71.92, 19.86, 8.22 in that order. You fill the column. You are done. That is a calculation. Now let's see how you write the report. How you write a common size report. That's the next section. The common size report. How to write a common size report. And that is all. For that one, the report. So it will still obey the report structures or the systems, such as the address, to, from, date, subject, introduction, and then the main body will be the common size analysis. Then you are done. Don't forget that once there's a report or memo, you have to sign and write your full name. Once there's memo and report, you have to sign and write your full name at the bottom. Yes. Okay. Yes, liabilities to everything, equity, all the items in the financial position, the balance sheet item, divided by the total asset, everything in the balance sheet, including liability, including all the liabilities, including all equities, everything. It must be by total asset. So long as it's financial position, it must be total asset. You are done. Okay. Now the report on a common size is very straightforward, and then it takes form of descriptive essay or analysis. Now we are describing figures. So for instance, something like this. I'll start tell the examiner that, oh, Akwesi Papa Limited total assets 71.9%, like commentary. Odododio constituency. Then you start mentioning the figures. That's all. So 2017, 71.92% of the total assets represent PP. 19.86 is for inventory. Then 8.22 receivable. Then you give us the implication. What's the implication? So if your non-current assets are more than your current assets, what does it imply? That's all. You're done. So we promise that we start with the P&L first, with the profit and loss. How to write the profit and loss? Now the profit and loss, we have we will start from the sales. So we start from the cost of sales. Now, if you go and it's 1 year like this, that one is so straightforward. But if it's 2 years, it become a bit trend and common size. So that one, we are moving it from last year to this year, current to previous. So let's start the whole show for that of profits or loss. So we will use the calculated figures. So I'll project the calculated figures, then we use it. So let's go to the profit and loss. So great. Please, this if they ask for a report, there must be an introduction. It must follow the report format, the report structure. What will change is that the body, the introduction, the same, 3 sentences. What I come to do, type of report, limitation, you are done. So it follows the same structure. If it is a report or memo, it must obey the structure. For instance, this question asks for a memo. So we use the memo format. Yeah, we use a memo format. Good. So you see the introduction. Good. Perfect. So that's the introduction of it. Now, cost of sales. Current year is 66.6%, and last year is 60%. So here you check. So you say cost of sales to sales ratio has increased over the period, leading to a decline in the gross profit to sales ratio. And as you can see here, how we get it. If the common size analysis is for 2 years, then the analysis must be drawn for both years. If it is for just a year or just 1 year, is that one so straightforward. So for instance, if it's only for 2017, then I write a report like this. Cost of sales represents 60% of sales, leaving a gross profit of 40%. This implies that the majority of the company's sales are into cost of sales, like the production cost or the cost of sales are more than what have a higher percentage in sales. That is it. Then I'll come again. Distribution costs represent 10%, 10.6% of sales, whilst admin 1.6%, leaving an operating profit to sales ratio of 27.8. This implies that the operating cost of the company represent 12.2%, 12.2%, which fall below the cost of sales, Full stop. So, and hence, Akwesi Papa Limited has been efficient managing the operating cost than that of the cost of sales. You are done. So if it is just one line, the analysis or the report is just you are describing the figures. Oh, this represents this, 10% of this. That's all. You are just describing the figures that you've calculated. So everything that is a bit straightforward for us. Yeah. Okay. Great. Please, the distribution courses is here, but the name decided to disappear. Right after the gross profit, you can see there's plain space here, right? Plain, and that's the 10.6. It's in the question too. The same thing happened. Let's go to the question. If you go to the question to the same thing happened there. Good. Have you seen here? Here must be, so these figures is for distribution cost, but the name did not appear. So, and in fact, when solving this, we put everything in Excel. So Excel to do the same thing. So Excel to refuse to put a name for us. Good. So now let's start analysis together. Let's write a report. So if it's a report, let's assume that we are writing a report to the CEO, Akwesi Papa. So right, report. So to be B, report. And what do you do? Report the format to, from, date, subject, to Akwesi Papa. Just write to Akwesi Papa, the CEO. So Akwesi Papa, into bracket CEO. From If they don't address, no address, eh? If they don't address, you can address yourself. Oh yes. If they don't address you, but you have to put your name there. So, or bring your name and add consult to it. Yes, you are consultant. So let's say target consult. Hmm. Okay, so subject. In fact, this question is a memo. So take note, it's a memo. Memo, we just have to swap these two. This one goes up, this one comes down. That's all. For the memo, the rest is still the same. Target consult date. So 12th of January. This one I have to write it plenty. 12th of January. 12th of January 2021. Subject performance analysis. Performance analysis for 2018 year. You are done. We start with the introduction. Introduction. This one is a report, so as usual. This report seeks to analyze the performance of Akwesi Papa Limited. Akwesi Papa Limited for the recent years or recent period. Full stop. The analysis will be based on common size. Common size using the financial statement provided. Common size using the financial statement provided. Full stop. My analysis is limited to. If you see 2 years in the question, don't worry yourself. There are 2 years here. It's limited to selection of different accounting policy. You are done. Normally, the truth of the matter is that common size financial statements do not normally come with report memo. They just straight ask you to just do the analysis straightforward. So they don't come with these addresses. But Fred, I like worry, so that's why we put it in a format form. Yes. So that is it. I hope you get it. Then you start the analysis. Check very well the analysis. Either you will have just 1 year, or 2 years. The 2 years is very difficult than that of the 1 year. The 1 year is descriptive. They're just describing figures. You are done. Here is 2 years. So you are done with the introduction. Then you go to the body. The body, you start with the profit and loss. So profit or loss analysis. Profit and loss analysis. Then you talk about profit and loss in paragraphs. Then you go to financial position. So the financial position analysis, because all of them have a different base, so you cannot add them to the same paragraph. No, differentiate in the body. So profit and loss, and then the financial position. Okay. So that is it. So we will use the calculated answers to write the analysis. So take note. For this analysis, you are just describing figures. This analysis, you are just describing figures. Then you are done. You are describing figures. You are describing figures. Okay. Now let's use that of the ratios calculated. Okay, so they are here. So first, what do? You know that cost of sales to sales ratio has increased. Okay. So you start by saying that cost of sales to sales ratio has increased from 60% to what? 66.67% over the period. over what? The period, leading to a decline or a decrease in the gross profit margin, leading to a decrease in the gross profit margin. How we get it? That is the analysis. Good. That is the analysis. So very good. So I will start by saying that I'll start the main report. So I'm starting the main report. If they are two, it's a bit straightforward. Like they are two, and then it's only one, meaning 2 years and 1 year. Take note, common size can be 2 years or 1 year. So we tell the examiner that cost of sales to sales ratio increased from 60% to 66.67% over the period. Good. Over the period. Good. Leading to a decrease in the gross profit margin. Gross profit margin. Full stop. Tell the examiner if the cost of sales has increased. So it seems that these people, they are not managing their cost of sales well. So this suggests, it's a suggestion though. This suggests that Akwesi Papa Limited. This suggests that Akwesi Papa Limited has not been managing its cost of sales efficiently. Its cost of sales efficiently, leading to the deterioration in profitability. That is the report, leading to a decline or deterioration in profitability. So I've only talked about cost of sale and gross profit margin in one paragraph. So I'll go and pick the next one also. Now, admin expenses, distribution is 10.6. Admin is 1.6. Has it increased or decreased? I think it has decreased. So admin expense has dropped from 10.6 to 9.7. That's distribution. The one that without a name is the distribution. The one that without a name is the distribution. And I add it there is a distribution. But I cannot add it to. I wanted to add it to. No, add it to. Okay. So basically, so if you check distribution 10.6, it has dropped to 9.72. Admin 1.6, it has dropped to 1.11. So all the operating costs dropped, decreased. Okay. So now you're going to make a clear case. You're supposed to touch on each of them one after the other. But because all of them dropped, we can put them together in a one nice sentence. So the next paragraph, I'll talk about the operating expenses. So the operating expenses to the next paragraph. Operating expenses to sales ratio. Operating expenses to sales ratio decreased over the period. Decrease over the period. And this implies that the operating cost has been managed well. This implies the operating cost has been managed well. Servicing. So the guy or the company can control it operating cost, but when it comes to the cost of sales, no. And then that is it. So this is how we have to write the common size report if there are 2 years. Now the operating profit, did it decrease or increase? Good. So here we now move on to the next line. Even though operating expenses to sales ratio decreased over the period, even though the operating expenses to sales ratio decreased over the period, the operating profit margin recorded a deterioration or decrease. Recorded a deterioration. Full stop. We are done. Then I'll go to profit before interest and tax. Then move on to finance cost. Finance cost to sales ratio has increased over the period. Contributing to the decrease in the profit before tax. I like that too. The finance cost to sales ratio has increased over the period, contributing, it's a contributing factor, contributing to the declining in the profit before tax. Perfect. Then we move on to the next sentence. We go to the income tax. Income tax expense to sales ratio has decreased about 50%, which has moved in line with that of the operating cost, even though the profit after tax decreases over the period. Even though the profit after tax decreases over the period. We are done. We make overall. In overall, the overall performance of Akwesi Papa Limited, profitability has been deteriorated. The overall performance of Akwesi Papa suggests that there has been a deterioration in profitability. The overall profitability, so the overall performance of Akwesi Papa suggests that there has been what? A deterioration in profitability. That is all. You are done with the common size for stability. But if it's just a single year, 2017, that one you are just doing descriptive analysis. Oh, cost of sales is 60% of sales, giving a gross profit of 40%. That suggests that more cost of sales constitute higher percentage. So cost of sales constitutes 60%. So most of the sales push into cost of sales. Majority of the sales push into cost. You are earning more, but majority is going to the cost. You are earning more. The majority you are using it to cater for the expenses. So what are you earning? Your sales revenue, huge. Like, let's assume that you are selling something for 1,000 Ghana, but it costs you 998 cedis to acquire that item. So your profit is for 2 cedi. Ah, the thing that you are selling at 1,000 Ghana and your profit is 2 Ghana cedis. So imagine, so something like that, you have a clear case that most of your sales push into cost. That is it. That is the common size analysis. So you check for that item. So over here, you can see that here is 60%, right? So most of the sales push into cost, which is very bad. Which is very bad. Then 66 West. Good. So that's the common size analysis for profits or loss. So for common size, it's not something how do you call it? Something too abstract. No, it's a bit straightforward game. In fact, I call it what? Descriptive report. You are describing the figures that you've calculated. That is it. You are describing the figures. By using it to reflect on the company's profit. Okay, so that is it. Now let's take the operating profits again from the operating profit section. From the operating profit section. Good. So let's take from the operating profits again. Basically, that is it. Yes, here you are comparing figures to reflect the performance of the company. You are comparing figures to reflect the performance of the company. When it is 2 years, okay. When it's 2 years, here we are looking for the movement. If it is only 1 year, that's where you mostly depend on the figures. So if it's 2 years, you are looking for the changes in the ratios that you have calculated, the common size ratios that you have calculated. So you should take note. So for instance, what we have here, obviously we started by saying that cost of sales to sales ratio has increased from where? 60% to 66. So that means we are not basing it only for 1 year. We are comparing the 2 years over the period, leading to the decrease in what? A decrease in the gross profit margin. So we have told the examiner what has happened, its implication, and then the suggestion. And then we have given the reason, causes of this bad performance in it. So all the points are in it. Good. So now let's go to the operating profit. So let's go and pick the ratios here. Operating profit. So from here, everything, because this one is nothing here, we move straight to the finance cost. We move straight to the finance cost from the operating profit straight to the finance cost. Okay. I can audit this write up, like the report that we wrote. So let's see how we started. So look at how we started. Cost of sales to sales ratio has increased over the period, leading to a decline in the gross profit margin, which represents a deterioration in profitability. This could be due to inability of Akwesi Papa Limited to control its production cost and the cost of sales as well. The sales revenue decreased over the period, for sales revenue, one of them is increased. So, sales revenue, in fact, it decreased, which should have increased. Sorry, I think it's a correct statement. The sales revenue decreased over the period, which should have decreased the production cost and the cost of sales too, but it relatively increased instead. Okay, to make a clear point there. The operating cost to sales margin has decreased over the period, which represents an encouraging trend, although there has been a decrease in operating cost. The operating profit margin decreased over the period instead of increasing. Finance cost to sales ratio in that order. So right, then you come down. Overall performance. So the overall operating performance, that's the conclusion. Overall operating performance of Akwesi Papa Limited is below average with a decreasing in profitability. This this could be attributable to the reduction in the sales revenue by 28% and inability to control costs. Good. Recommendation. Management must work to increase sales levels as soon as possible or practicable by increasing advertising campaigns and diversing its product offering in order to improve profit margin. So please, I'm ready to provide further clarification when necessary. Thank you. Write down the recommendation. You sign and write your full name, Enoch Asante, and you sign. You're done with your common size report. For this report is just on the profit and loss. I wrote on profit and loss. Profit and loss. So that is it. Okay, so great. Okay. Okay. So basically that is it. Now let's see how best we can also write for that of the financial position. I've write a common size for financial position. Common size for financial position. So that one too, you are going to use that of the ratios calculated to do the analysis. So 2017, 2018. Great. So that one we start. If it's 2 years, that's where we normally compare the movement, changes in this value. So here, it has increased slightly from 71.92% to 72.4%. And then the inventory has also decreased over the period. Okay. So now let's see how best we can write this report. Let's see how best we can write for that of financial position. For financial position. Yes, please. You have to. Okay, so let's see how best we can, right? So we told the examiner that so we go to financial position. Just that here I concluded everything. So financial position. I'll start. PP. So in 2017, PPE, please no shortcut to begging you. It's an official report, no shortcut. PPE, danger. Hmm. Danger sign, yes, danger. Examination danger. In 2017, PPE represents 71.9 something percent of the total assets of what? Of the total assets amount, slightly, which increased slightly or marginally to that of 72 dot. If I let me use actual figures, I think I can't. So 71.92 to 72.44. It's increased slightly to 72.44%. Good. Full stop. You go to inventory. The next item on the list is inventory. So inventory, for inventory decrease. So I'll start the next sentence. Inventory represents 19.86% of the total assets in 2017, which decreased to which decreased to which decreased to so inventory represents 19.86% of the total assets in 2017, which decreased to 15 dot which decreased to 15.11%. Which decreased to 15.11%. Good. So which decreased to 15.11%, which contributed to an inflow of cash. So, or which resulted in the inflow of cash, making the company highly liquid in 2018. Yes, this is what we are saying. Obviously, when we do the cash flow, we said that decrease in inventory is an inflow, right? Yes, inventory decreases. Receivable also decreases, which brought money. which increases the cash from 0% up to 6.67%. So that is it. So the decrease in the inventory and receivable brought a lot of money to us, because when inventory decreases, it means that we are selling the goods, right? Perfect. When receivable decreases, it means that the guys are bringing the money, right? Perfect. So that means our money must go up top, and that's the implication. You are done with your analysis. That is, you're reviewing the performance. So here the liquidity position has been improved as a result of the decrease in the inventory to total asset ratio, and likewise the receivable. You are done. Likewise the receivable. So, and that is how the report will go. So we are continuing. Receivable to total asset ratio. The last sentence. Great. So taking the inventory section, we said that inventory represents 19.86% of total assets in 2017. Perfect. Which decreased to what? So decreased to 15.11%. Decreased to 15.11%. Contributing to the increase in the cash flow or increase in the liquidity position, or okay, good. This resulted in an inflow of cash, making the company highly liquid in 2018. Good. So this resulted in an inflow of what? Cash, making the company highly liquid in 2018. That is it. So it means the liquidity position has been improved. Yeah, liquidity position has been what? Improved as a result of this decrease the inventory, because the inventory is going down. They are selling them to receive money. Now let's go to receivable. So you take each of the item one after the other, line by line. So inventory, you talk about inventory. Now check if inventory increases. Oh, tell the examiner that it will take money away, because where do you get the money to go and buy the inventory? Where do you take the money to go and buy the inventory? Tell us. You took the money from the company to go and buy the goods. So the cash have to decrease if your inventory increases. So that is it. If the inventory increases, it will affect the cash. Likewise, the receivable. Don't forget the three items. Changes in working capital, inventory, receivable, and payable. It will have a direct impact on your cash. Inventory, receivable, and payable. So anytime you are explaining, using the common size, explaining inventory, receivable, and payable, direct your path to the cash or the liquid asset. Direct your path there, and then you are done. Okay, so that is it. Now let's go to receivable. Receivable to total assets as move in line with the inventory with a decrease over the period, and also contributing to inflow of cash. Inflow of cash. Inflow of cash. Good. Now let's go to cash at bank. We don't have a figure for 2017, so move straight to 2018, but you can move it from there. In 2018, cash at bank represents 6.67% of the total assets. In 2018, cash at bank represents 6.67% of total assets, which better of the company's liquidity position. Which better of the company's liquidity position? Which better of the company liquidity position? Better of the company liquidity position? Full stop. This is as a result of the decrease in the receivable and the inventory. This is as a result of decrease in the receivable and the inventory. That is it. So overall, the company Akwesi Papa Limited holds more long-term assets holds more long-term assets than the short-term assets for administrative purposes. Or for operations or production purposes. Good. For production purposes. Okay. Now from the assets, then you move straight, extremely straight, extremely what? Straight to the equity. When you go to the equity, just pick the ordinary share or the total equity if they have it. This is the total equity. This very one is the total equity. When you get there, straight. Now we've talked about the company. Now one thing too you can also factor in is this. You check the company. If it's non-current assets, all the non-current assets is made up of PPE. Oh, then such company is a manufacturing company. All your non-current assets is PPE. That company is a manufacturing company. But in a situation where you have investment among the non-current asset, then such company, if the investment is like more than the PPE, then that company is not a manufacturing company. Because for every manufacturing company, you invest in your PPEs, in your production plant, not like investing elsewhere. Taking huge money, go and deposit it, and then getting little interest. Meanwhile, you need money to buy or expand your capital base, your production plant. So for instance, if you go to something like Gasim, if you pick Gasim financial statement, and pick their non-current asset, I am expecting PP should occupy higher percentage. Because GASM, if they want expansion, they will not go and invest their funds. Good. That is it. Now, when you go to ordinary share, just pick the total. Tell the examiner that 47.94% of the asset is being financed by equity. 47.49% of the asset being financed by what? Equity. 49. With the remaining being financed by debt. With the remaining being financed by debt. So now you can do the grouping. Normally that section, we only need the total of the current liability. Their total. What's the current liability total? That's the 24.66. Then here too is 27. So when you go to the equity section, just tell the examiner that in 2017, 47.94% of the assets was financed by equity, which increased to 57.78 in 2018. Full stop. I'm done. With the remaining balance being financed by the non-current liabilities and then the current liabilities. So we start again. When you go to the non-current liabilities, the 10% debenture. So 27.40% of the total asset is being financed by the debenture loan, proceeds from the loan in 2017, which decreased to 17.78 in 2018, with the remainder being financed by the current asset, current liability. Then if you pick the current liabilities too, tell the examiner that 24.66% of the total asset is being financed by current liability. And this remain almost the same in that of 2018. Full stop. We are done. That's the end of the analysis of the common size. That is all. Overall, the liquidity position of Akwesi Papa look good. Despite the deterioration in profitability, you are done. Overall, the liquidity position of Akwesi Papa look good. Despite the deterioration in profitability. We are done. If you go and it's just 1 year, oh, that one is good news. Like the question that we have posted on the platform. That is the last sentence question. So we'll consider that. Let me see if I can project that one for us to go through. Good. Now let's look at this question. Let's take the requirement again. Unless you turn it upside down. A. Analyze the liquidity and solvency position of the company, supporting your analysis with computed ratios. 10 marks. This is last sitting's own. Great. B. Prepare a common size statement of financial position. So common size statement of financial position simple means just calculate the percentage for us. We are done. That's a common size financial statement. Calculating the percentage alone is a common size financial statement. For financial position, no profit and loss, financial position. Then, and analyze the financial position of Impuntio Limited based on the common size financial statement. So analyze the financial position, the balance sheet. You're going to analyze the balance sheet. Good. Now let's see from this question. We will go to that of we will look at the main question itself. Great. I just want to boost your morale. Okay, so here to the same thing. Write a report of board of acquisition by analyzing the financial position of the company using any two key ratios: liquidity and solvency are the financial position ratio. Going for 10 marks, right? Using common size vertical analysis, write a memo to evaluate the performance of the company. Another 10 marks. Good. So let's go and look at that particular question that we read first. It's financial statement. Then we are done. Oh yeah, it, it's fine. Great. Go through the question that we read first. So this is the actual question. Everything is very lengthy. So they say prepare the common size financial statement. So very lengthy. So locate the total assets. What's the total asset here? The examiner is very good though. He's done everything for you. 657,955.00. If I clear that dot 00 from there, just go. It's 657,955. You are done. So you pick all the items. So long-term investment, 150,000. You put it there. If you see long-term investment in the question, kindly check its percentage. If its percentage is more, oh, then it is not a manufacturing company. Because a manufacturing company will not have a long-term investment. For manufacturing company, you should invest in your plant and machinery. Buy a lot of plants, buying a lot of machinery, equipment for production purposes. But if you are investing your money, then you are not a manufacturing company, like a service company. Take audit firm, take audit firm, take banks, take company like finance houses. When they get their money, ask yourself what they use the money for. So if an audit firm get a lot of money, what are they going to the money for? Wisely, they have to invest. So for that matter, they will have a long-term investment, a lot of them. Because audit firm will not go and buy a plant for what? For which production? No. Gasim. When Gasim got a lot of money, the first thing come to mind, let's increase our production capacity to be producing more. So buying more equipment. That is the analysis that we want to drive from you. That is the analysis that we want you to like bring out for us. Then you are done. So you see the financial statement, very lengthy, detailed one. So you take your time, and the figures too are like a bit huge. Yes, a bit huge. So you take 150,000 divided by the total asset, all the items in here divided by the total assets. You are done. That's the first requirement. Then you write your report. You start. Then you are done. So I hope you get it. Great. Great. So let's see how best you can write this. Then you are done. So all what you have to do is first, common size statement of financial position assets, percentage. All the items that you see, you express them as a percentage of the total asset. Please, here we don't need workings. We don't need formulas because the formula is only one. Because as the thing look, it's many. So you have to do all of them one after the other. All of them one after the other. One after the other. As they prepare the financial statements. One after the other. So that's all. Then you start with your analysis. So Analysis of the common size statement. Of the total asset of the company, 38.4%, 38.45% is non-current asset, while 61.55% is current asset. The implication is that the company holds more liquid asset than it holds in long-term assets. Okay. For production purposes, the bulk of non-current assets is in investment. This clearly indicates that the company is not a manufacturing company, yes, which confirmed to the reality, the norm. That's the normal. And it has less assets for production. Oh, yes, because like audit firm will not go and buy production machines. Bank will not go and buy manufacturing plant. What for? They will not do that. Bank, the plant or the machines that they buy, they will invest in technology, advanced technology, and then equipment like electronic gadgets to enable their service more easily. Then facility, yes. Banks normally also invest in facility. Aside technology, second aspect is facility. So the building, yeah, that is it. So basically, in a current asset, huge chunk of 54.71% is in cash. The company holds too much cash and near cash resources. Then that's all for the asset side. You go to total assets are financed mainly from equity, 8.49%. Total asset financed by equity, only 15% of the total asset financed by long-term loan, long-term debt, and then that's all. That's so that's all. That's all about the common size. This is one leg. This is one leg, like just 1 year. Good, and then that is it. So basically, that is the end of our analysis and the ratios. Please and please again. You should know limitations. When the examiner make this comment, comment about the limitation of your analysis. If your analysis is intercompany, it have its own limitation. If your analysis is about trend, it have its own limitation. Intercompany, you are comparing company A to company B. Trend, company A 2017, company A 2016, and so on. That's a trend analysis. Each of them have their own particular limitation. So for instance, the limitations are number one, at least you know 3, 3, 3, 3, 2, number three, or number four. Number one, selection of different accounting policy. It should be a limitation here. Selection of what? Different accounting policy. Here will be what? Changes in accounting policy. How do you get it? Here you can have what you call different operating capacity. Different operating capacity. Here you can also talk about unique circumstances or exceptional transaction. Unique transaction. Unique transaction. Maybe what happened in 2017 did not repeated itself 2016 or 2018. Like you are comparing 2020 performance to 2019. Chai. Have you seen? If you compare 2020 2019, there is a unique transaction 2020. COVID destroy business. 2020 no COVID. So it's limited. Your analysis is limited. You can't tell us that 2020 you are doing bad. Take COVID away before. Then it also talks about reporting system. different reporting system here can also have impact. Good. Different reporting system, like the reporting period. Yes. Even though we are in the same industry, but sometimes we will have a different reporting period, which will have impact on the performance analysis. Most of the exam questions that we see, they are of the same reporting period. Good. So take note of that. Yeah. And then you see the limitation that we gave out. You can recast them. You can recast them, and then here does not review the size of the organization. So the size. It does not take into consideration the size. Assume you are comparing MTN Ghana to Glow Ghana. Have you seen? Ratio will not tell that MTN Ghana is over 20 years in Ghana, but Glow is just over 5 to 7 years. Have you seen? In that order. So take note when we ask you comment about the limitation of your analysis. You see the word of your analysis. Of your analysis. It means that the analysis that you've done, you have performed for us. What is the limitation? Specific, not the general. But if you don't see your there and we ask you comment about the limitation of ratio analysis, just the general limitation. Oh, then put all the limitations that I gave you, put all of them there for the examiner. You are done. Okay. So on that note, that's the end of the game. Thank you very much for coming. Great. So we look at this straight to the requirement. It says that as a credit control officer, prepare a report to the credit control manager of your bank, commenting on the financial position using solvency and liquidity of ANCO and suggest whether the facility should be granted. 16 marks. And the B part was comment on your analysis. The limitation of the analysis was for 4 marks. Yeah, comment about the limitation of your analysis. So here, solvency and liquidity. Solvency and liquidity. So all what you have to do is you calculate your liquidity ratio 2. Solvency 2. That's all. 2, 2, 2, 2, 2. So solvency 2, liquidity 2 for all these years. So the rest of the figures, you don't need them all. Not at all. Like, no, don't worry yourself. So that is it. So all this material will be available to you. Kindly use them. Finish all this material for me. Let's go straight to the suggested solution provided. Let's audit the solution. So you see ANCO. So this is a report. Reports. So look at the starting of. Let's go to the ratio calculation first. Let's go to the calculation of the ratio first. It was an appendix. Current ratio. So if I just the formula scattered, it was calculated here. Quick ratio. That's all for liquidity. Then debt to equity and debt to asset. That's all. 4 ratios. 4 ratios. So we have used 4 ratios to write a report on ANCO. A full report on ANCO. Don't say that the ratios are not many, so you can't write a nice report. Oh, so first, introduction. So you know the rule for reports. So to credit control manager from credit control officer, date 13th July 2020. That when the exams were sitting 13 July 2020. That's last sitting, right? Subject: performance analysis of ANCO. Please, following the discussion we had on the above subject matter, this report seeks to analyze the financial position of ANCO, and it, in fact, the original question was An and Co. So we call it ANCO, and suggesting whether the facility requested should be granted as you requested. The report will be based on trend analysis assessing the financial position of ANCO from 2015 to 2018 financial year using the following key ratios: liquidity and solvency, which form the basis of assessment as shown in the appendix. Here, I did not give a limitation because in that particular question, this is not a full question. I asked for the limitation of your analysis. So that one, I don't need to include it in the introduction again. So I'm not including it in the introduction. So there was a four marker question on its own, asking for it. So I'll not waste my time and bring it in my introduction. Then we started liquidity. As usual, the first paragraph should talk about liquidity in general. Second paragraph should explain your current ratio. Third paragraph should look at quick ratio. That's all. Liquidity ratios analyze the ability of the entity to meet its short-term obligation as and when they become due. In other words, these ratios shows the cash levels of the company and ability to turn other assets into cash to pay off liabilities. To pay off present liability should be present and other current obligations. Liquidity is said to be good when an entity has enough assets in a form of cash or assets easily convertible to cash to settle its immediate obligation. The current ratio explains the number of times the current asset can be used to settle the current liabilities. Yeah, then. The current ratio has slightly or marginally increased over the years. This represents an encouraging trend. This this could be as a result of slight increase in ANCO's current assets. Like that. So write something small there. You go there, move on to the next paragraph. You are down with liquidity. You talk about quick ratio or the asset test small in the ninth paragraph. You go to solvency. Use the first paragraph to talk about solvency. Then the second paragraph here to talk about debt to equity and debt to asset. That's all. Here you cannot calculate interest cover. Take note, you cannot calculate interest cover because there's no P&L here. Interest cover is part of solvency ratios. You cannot calculate because there's no P&L in the question. Then in conclusion, ANCO have a weak liquidity position while solvency risk is low, and hence the facility can be granted following further non-financial analysis. And I'll leave it to management. Please, I'm ready to provide further clarification where necessary. Thank you. Don't forget, in Okasanti, then I sign. That's all. Exams, I'm expecting you to do the same. If it's a report and memo, if they don't say report and memo, don't go by the format. That one, they want it empty like that. That's all. Okay.